Welcome to vTalkInsight Allocator's Lens Daily for December 13th, 2025. We are in a late cycle but still growth-supportive world, where AI investment and fiscal tailwinds meet higher long-term yields, rich valuations, and rising geopolitical tension. Today we will connect how equities, rates, credit, currencies, and commodities are all repricing that balance of resilience versus risk. In equities, the dominant theme is rotation rather than a simple risk-on or risk-off move. Headline indices like the S&P 500 remain close to record highs, and volatility gauges are still sitting in the mid-teens. Yet the leadership underneath has shifted meaningfully away from a narrow set of mega-cap AI names. Small caps and value stocks have been outperforming, with the Russell benchmarks making new highs and outpacing the large-cap indices over the past month, helped by the Federal Reserve's dovish cutting cycle and a steepening yield curve that is friendlier to financials and cyclicals. Financials, industrials, transports, and other previously lagging sectors are now printing records, and there is growing evidence that earnings growth outside the AI leaders is picking up, which supports a more diversified equity profile than earlier in the year. AI remains the central macro and equity story, but it is increasingly two-sided at the stock level. On one hand, chip and infrastructure providers are flagging extraordinary demand. Broadcom, for example, is guiding to AI sales that are far above prior expectations, with AI revenues doubling year-on-year and strong commitment from major cloud clients. Data center suppliers see double-digit annual growth over the next 5 years, and policymakers now openly describe AI capital expenditure as a key driver of gross domestic product and earnings, with projected double-digit S&P 500 profit growth linked to productivity gains spreading beyond big tech into financials, healthcare, and retail. On the other hand, recent pullbacks in AI infrastructure names after earnings surprises or rumors around data center delays show how sensitive valuations have become to execution risk, even when long-term demand stories remain intact. Valuation is the main constraint on the otherwise constructive equity narrative. It is not just the mega-cap names that are expensive. The rest of the S&P 500 is still trading at earnings multiples in the low 20s, even though many of those companies have weaker margins and slower growth than the headline leaders. Consensus expects double-digit equity gains to continue into 2026, and risk assets broadly are priced for strong AI-led productivity, resilient growth, and benign inflation. That price-for-perfection setup leaves little cushion if growth undershoots, if the labor market weakens faster than expected, or if tariffs and consumer stress start to bite more meaningfully into demand as we approach the 2026 tariff peak. We are also seeing clear AI investment fatigue in some quarters, with investors demanding proof of revenue and profit before rewarding new capital spending, which introduces a higher bar for future announcements. Beneath the strong macro headlines, the consumer picture is more nuanced for equities. Lower-income households are increasingly relying on credit cards. Car repossessions are at records, and essential costs such as healthcare and insurance continue to rise, which creates a more fragile backdrop for consumer discretionary and lower-quality retail names, even as premium brands still report solid results. Policy risk adds another layer, with gridlock around healthcare subsidies threatening coverage for tens of millions and potentially injecting volatility into healthcare and insurance stocks. All of this reinforces a dispersion-driven equity market, where stock selection and sector tilts matter more than index beta, and where positive surprises like recent retail earnings beats can coexist with sharp drawdowns in individual AI infrastructure or software names. Globally, investors are starting to look beyond the United States for equity participation. Geopolitical fragmentation and reshoring are seen as long-term positives for select emerging markets, which benefit from better demographics, cheaper valuations, and higher yields, while a softer or more stable dollar path could further support non-U.S. and emerging market equities. At the portfolio level, a traditional 60-40 mix of global stocks and bonds has delivered strong double-digit returns this year, with less volatility than pure equity exposure, underscoring that the rally is not limited to one asset class. The equity takeaway is that the cycle still looks earnings supportive, but with elevated valuations, heavy AI expectations, and consumer and policy risks leaving less room for error, making the evolution of the rates and credit stories especially important for equity risk appetite. Turning to rates, the front end of the curve is dominated by a powerful but increasingly debated Fed easing cycle. The Federal Reserve has now cut policy rates 3 meetings in a row, delivering about 175 basis points of easing since September, and has paired that with bill purchases and an early pause in balance sheet runoff that collectively ease financial conditions and support liquidity. Official projections point to a gradual move toward a neutral stance, with policy rates eventually settling in the low to mid 3% range once inflation is closer to 2.5%. That said, the Fed's own forecast for higher growth and lower unemployment next year, combined with some reluctance from individual officials to front-load cuts while inflation remains above target, mean that the bar for further near-term easing may be higher than markets have been assuming. While the front end is anchored by the cutting cycle and liquidity operations, the long end is sending a different message. 10 and 30-year Treasury yields have risen for 2 consecutive weeks, and the gap between 2 and 10-year maturities has widened by around 10 basis points, marking the steepest curve since the spring. That steepening reflects persistent concerns about fiscal deficits, heavy issuance, and the possibility that AI-driven productivity ultimately supports higher real interest rates, even if the policy rate itself drifts lower. It also mirrors a sense that inflation may not glide back to target as quickly as hoped, particularly if commodity prices or wage dynamics reaccelerate, which would limit how far and how fast the Fed can cut without undermining its inflation credibility. Outside the United States, policy paths are diverging further. The United Kingdom offers a good illustration. Gross domestic product has contracted marginally for 2 consecutive months, and markets expect the Bank of England to deliver a rate cut soon. However, headline inflation is still running well above the 2% target and is only expected to approach that level after a large drop next spring linked to budget measures, while there is limited room for further cuts and a persistent hawkish bloc on the policy committee. Gilt markets also face heightened political risk ahead of elections, with uncertainty around future tax hikes and fiscal consolidation weighing on sovereign risk premia. By contrast, some emerging market central banks look set to gain more room to ease in 2026, helped by deflationary pressure from Chinese exports keeping global goods inflation in check. For allocators, the rate backdrop remains a delicate balance between supportive policy at the front end and unresolved risks at the long end. The Fed is highly data-dependent and internally divided, with futures markets still pricing more cuts than the official guidance. So each incremental labor and inflation release has the potential to shift expectations rapidly. Curve steepening is helping bank profitability and supporting financial equities, but also tightens valuation math for long-duration assets and amplifies the importance of duration positioning across portfolios. Key watch points are whether long-end yields continue to grind higher despite cuts, how quickly reserve conditions in funding markets approach non-ample territory, and whether any renewed inflation shock from commodities or tariffs forces central banks back toward a higher-for-longer narrative. Credit markets continue to look resilient on the surface, but with clear late-cycle characteristics. Corporate bond spreads remain historically tight, and that tightness is broadly supported by solid fundamentals. Many companies are not increasing leverage materially, balance sheets are generally healthy, and default rates in private equity-backed portfolios are running at roughly 1%. Investment-grade bonds offer attractive yields over treasuries and remain a compelling income source, while high yield appears less compensated for potential volatility given how narrow spreads have become. At the same time, several large investment managers report holding elevated cash and being underweight both investment-grade and high yield, preferring to wait for better entry points or dislocations rather than chase tight valuations into year-end. Supply dynamics are poised to be an important driver as we enter the new year. Heavy corporate bond issuance is anticipated in January, particularly from firms tied to AI and data center buildouts, as well as from utilities and industrials facing large capital expenditure needs. Merger and acquisition activity is running at one of the highest paces on record outside the 2021 peak, and that deal momentum is feeding through to larger, more diverse bond deals across the curve. With spreads already tight, this wave of issuance is likely to generate more dispersion between sectors and issuers and could produce temporary spread widening episodes that active investors have been waiting to exploit. The main vulnerabilities in credit sit in pockets exposed to the consumer and to aggressive AI investment plans. Rising credit card balances, record auto repossessions, and increasing financial stress for lower-income households all pose risks to consumer asset-backed securities and to lower-quality issuers that rely on discretionary spending. On the corporate side, the sharp widening of 5-year credit default swap spreads for Oracle over the past month highlights how quickly perceptions can shift when a company combines high leverage, large AI-related capital expenditure, and uncertainty over the profitability of flagship contracts. Growing investor skepticism around opaque private credit structures, particularly where exposure to single technology stories is concentrated, adds another late-cycle layer to the risk profile. For multi-asset allocators, credit is acting as an important barometer of how much risk markets are willing to tolerate. So far, tight spreads, strong demand for new deals, and very low default rates point to confidence in the soft landing narrative and in AI-driven growth. However, the combination of stretched valuations, rising single-name idiosyncratic risk, and a mature credit cycle means that any sustained widening in investment-grade or high-yield indices would be a meaningful signal that the balance between growth and policy support is shifting. Monitoring new issuance receptions, changes in positioning, and how quickly troubled credits can refinance will be key to gauging whether credit remains a quiet supporter of risk assets or turns into a source of instability. In foreign exchange, the U.S. dollar sits at the intersection of the rates and equity stories, with two credible but opposing narratives. One view holds that the dollar should stabilize in 2025. U.S. growth is expected to remain relatively resilient. The Fed may deliver fewer cuts than markets currently discount, and strong equity inflows into a still dominant U.S. stock market provide ongoing support. The alternative view emphasizes the cumulative effect of the Fed's substantial easing, the prospect of further cuts, and rising yields elsewhere, all of which could pressure the dollar lower over time and historically have benefited international and emerging market equities. Policy divergence beyond the United States adds nuance to the currency picture. The yen is widely seen as undervalued on a fundamental basis, and any shift in Bank of Japan guidance or signaling toward less accommodative policy could be a powerful catalyst for appreciation, particularly if U.S. cuts proceed as expected. Meanwhile, contained inflation in several emerging economies, combined with deflationary pressure from Chinese exports, is creating room for emerging market central banks to pursue their own easing cycles in 2026. That backdrop underpins a constructive stance on certain emerging market local assets, where real yields remain attractive and domestic policy can increasingly focus on growth rather than just inflation control. From a cross-asset standpoint, currencies are an important transmission channel for the macro themes we have discussed. A softer dollar would tend to support commodities and non-U.S. risk assets, help relieve some external funding pressure for emerging markets, and reinforce the rotation into international and value exposures that we are already seeing in equities. Conversely, any renewed dollar strength driven by fewer Fed cuts or a growth scare outside the United States would tighten global financial conditions and could reintroduce pressure on more leveraged or dollar-dependent borrowers. Key watch points include how quickly the Fed's path converges toward or away from market pricing, potential inflection points in Bank of Japan communication, and the evolution of Chinese trade and tariff policies. Commodities round out the cross-asset picture with a striking divergence between metals and energy. Precious and industrial metals are benefiting from a mix of AI-driven demand, energy transition investment, and geopolitical hedging, while oil prices have lagged and are expected to drift lower as oversupply becomes more evident. These divergent paths carry important implications for inflation expectations, central bank policy, and regional winners and losers across both developed and emerging markets. Gold is in what many see as a structural uptrend. Forecasts point to the possibility of gold prices moving substantially higher by the end of 2026, driven by sustained central bank purchases, continued inflows into exchange-traded products, and a generally higher level of geopolitical and policy uncertainty. Gold is increasingly framed as a strategic diversifier with its own set of drivers, complementary to but distinct from both equities and bonds. Silver has already been one of the standout performers this year, more than doubling in price on the back of a weaker dollar and strong speculative interest, which underscores both the appeal of precious metals in a late-cycle environment and the potential for sharp volatility if positioning turns. In base metals, copper is the focal point for the intersection of AI, electrification, and defense spending. Analysts see persistent market deficits driven by traditional demand, green transition infrastructure, data center expansion, and stockpiling, while the supply side struggles to respond quickly due to long mine development timelines. Copper prices are projected to reach much higher levels by 2026, with some forecasts pointing toward around $12,500 per ton, even after accounting for distortions from tariff-related stockpiling. For allocators, copper is effectively a barometer of how aggressively the world is investing in the AI and energy transition stories, and sustained strength would reinforce the idea of structurally higher capital expenditure and potential upside risks to medium-term inflation. Oil, by contrast, looks softer in the baseline outlook. Prices are expected to drift toward about $50 a barrel as current support from Chinese strategic reserve buying fades and underlying oversupply becomes clearer. However, the geopolitical overlay remains significant. Recent U.S. actions against Chinese shipments to Iran, rising tensions around Venezuela, following an oil tanker seizure, and moves to freeze Russian assets indefinitely all highlight how quickly supply expectations and risk premia can change. If crude were to stabilize or rebound on the back of such tensions, it could add to inflationary pressures and potentially nudge central banks toward a more hawkish stance than markets currently price, feeding back into both rates and equities. Putting all together, the cross-asset picture still tilts toward growth, but with a thinner margin for error. Equities benefit from broadening leadership and an AI-supported earnings outlook, yet sit on rich valuations that leave them vulnerable to any disappointment in growth, inflation, or policy. Rates markets reflect that tension, with aggressive front-end cuts and liquidity support coexisting alongside higher long-term yields and a steepening curve that signal lingering concerns over inflation and fiscal sustainability. Credit remains tight, but fundamentally sound. Though single-name and consumer stresses are rising at the edges, while foreign exchange and commodities redistribute the macro story across regions through a potentially softer dollar, an undervalued yen, and strong precious and industrial metals against softer oil. For allocators, the key watch points now are AI monetization and capex discipline, incoming labor and inflation data, the trajectory of long-end yields, and any geopolitical flare-ups that might reprice commodities and policy expectations. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.